capital employed and the weighted average cost of capital, my firm will be able to command a higher price to earning multiple as well. And this difference for how many years my company can sustain is called as a competitive advantage period, CAP. And that is something we need to understand. It's very, very important. People tend to track it, calculate that by different models. But this metric, at least from a definition point of view, you should know. Okay, so it's plan. Also, one more thing, a company having a lower terminal value, because much of the company's valuation in the financial modeling exercise comes from terminal value, and that is something that we learn. Much of the valuation of the company I'll just show you that as well. Just give me a second. So much of the value of the company, if you see in this model, so much of the value, if you see, is coming from the terminal value. I'll just zoom in, zoom out. You see this number. So this number that you see, 4711, is the present value of the future free cash flows. Correct? 4711 is the present value of the future free cash flows. Terminal value is 40 by 461, and 27826. 826 is the present value of my terminal value. So one is the present value of my future free cash flows plus the present value of my terminal value, and when you add both these numbers as the zoom out, and when you add both these numbers, you simply get the company's enterprise value. You simply get the company's enterprise value when you simply add both these numbers. So my enterprise value is nothing but the present value of the future free cash flows plus the present value of the terminal value. And my present value of the terminal value number should always be higher than the present value of the future free cash flows. Because that states that my business is meant to grow in future. I have no intention to shut down the operations. My business will grow, prosper, diversify and capture the market share. But if my terminal value is less than the present value of the future free cash flows, it means something is wrong. My business might not grow. There is no intention to grow the operations. A business having a higher terminal value, will always command a higher price to earning multiple, because that business is bound to grow well, better and for long. And that business will also be having a sustained competitive advantage period, that is higher years in sustaining the ROCE over the cost of capital. And that is something we need to know. If the terminal value comes down, in the second scenario, if the terminal value comes down or starts to get reduced, in that way the price to earning multiple will also come down, because there is future growth hamperment. Right? It might happen that the future growth is getting hampered, and due to that, the price to earning multiple will come down. Because the price to earning multiple signifies the company's future growth as well. If the future growth is low, if the terminal value is being questioned, the price to earning multiple shall come down. And again, you cannot ignore the fundamentals as well. The classic example is in the case of IT industry. If you see IT industry stocks, especially large cap IT companies, Infosys, Wipro, TCS, Tech Mahindra, HCL, it has corrected by more than 30-40%. The multiples have crashed. The multiples have come down to 12 times, 13 times, 14 times. Because the terminal value of these businesses, large cap IT companies, is getting questioned now. Because the businesses models have been heard by the AI and Anthropics of the world, OpenAI, all these companies. So these have been eating away the businesses of these large cap, old age, legacy business companies, IT companies per se. So whenever you forecast the business model or the financial model for large cap IT companies, in reality, the terminal value of these companies have started to come down. So for example, if the present value of the terminal value had been 27,826, this value has started to come down for large cap IT companies from 25 to 20 to 19 to 18. And that is the reason that many of the analysts in the market comment that the large cap IT companies are into trouble. Their price to earning multiples have corrected a lot. We used to trade at 25 times, 30 times. From that particular point of time, the multiples have come down to 15 times, 12 times, when a trailing price to earning multiple. The forward price to earning multiples are even lower. So the terminal value is getting hit, and that is the reason the future price to earning multiples are coming down in one fashion. because the price to earning multiple needs to be taken into conjunction with both the growth of the business, earning growth of the business, and the terminal value. It can still happen the business is not giving you earning growth. The business might not be giving you earning growth, and the terminal value might be into question. The price to earning multiple might be low. There can be some scenarios in which the business might be giving you higher earnings. So technically, when my business is giving me higher EPS, my price to earning should come down, right? But the higher earnings are supported by higher price movement as well, and higher future terminal value growth as well. My price to earning multiple will still be high. So you cannot say that 20 is cheap or 10 is cheap or 5 is cheap. Correct? So that we need to understand evaluation models. So these type of questions can be asked to you. Correct? So that is something we need to understand. ठीक है, तो वो हमको समझना है, टर्मिनल वैल्यू के बारे में समझना है, कैश फ्लो स्टेटमेंट के बारे में समझना है. So cash flow statement में again you have to understand that the major business of a company is coming from the cash flow from the